We now move on to question number 5A. It's from the topic of depreciation and carries 5 marks. This question appeared in the May 2025 paper of accountancy. What you need to keep in mind as far as depreciation is concerned is the asset, the date of their purchase. Second, the method of depreciation being used. And third, in case there is a sale, the profit or loss on sale. We now move on to the solution. It is to be recorded in the books of Maritime Limited. We are preparing the machinery account has been told to us. We are purchasing the first machinery on 1st July 22 for a cost of rupees 1,38,000. Remember, this 1,38,000 is inclusive of reconditioning the asset. The price at which it was purchased was 1,20,000, but for the reconditioning cost is 18,000. So the total cost of the asset is 1,38,000. That means the reconditioning cost has been capitalized. We then move on to the second asset which is purchased during the same financial year, 1st January 23. Asset number 2 has been purchased for rupees 72,000. So we have recorded the purchases. There is no sales. So we go to the end of the year, that's 31st March 23, to record the depreciation. Now mind you, depreciation will be calculated on asset 1 and asset 2 under the straight line method at the rate of 15%. It's also called as depreciation on cost. The first asset has been utilized for 9 months. The second asset has been utilized for 3 months. So the total depreciation on the 2 assets for the year ended 31st March 23 is 18,225. We close the account and bring forward the balance to the next year. The opening date, 1st April 23, the balance brought down 1,91,775. In the year 2, that is 2023 to 2024, 31st March 24, there is no purchase, no sale. So we get down to calculate the depreciation for the year ended 31st March 24 on the 2 assets. Asset 1, which has a cost 1,38,000, asset 2, which has a cost 72,000. For the entire duration of its use, that's 12 months, the total depreciation works out to 31,500. We close the account for the year and carry forward the balance and bring down the balance to the next year, that is on 1st April 24, the written down value 1,60,275. In this particular year, we note that there is a sale of asset number 2 and the price at which it is being sold is 48,000. What we need to do in our working note is to check out what was the book value of this asset on the date of sale. And on the date of sale, asset 2 has a book value of 55,800. Mind you, I have charged depreciation for the current year up to the date of its use, that is 3 months, that's 2,700. And after that, we get the written down value as 55,800. The price at which it is sold, 48,000. So the selling price is less than the book value. Therefore, it's a loss. And the loss will be transferred to the profit and loss account. That's 7,800. Then on 30th June 24 of the same year, we are purchasing asset number 3. The cost of this asset is 90,000. So we have recorded the purchase and the sale for the year 24-25. Now what we need to do, when at the end of the year, 31st March 25, I will calculate the depreciation on the asset. Asset number 1, cost 1,38,000, used for the full duration of 12 months, 20,700. Asset number 3, cost 90,000, used for the period of 9 months, 10,125. So I record the depreciation on the remaining balance assets, 30,825. As mentioned earlier, I have recorded the depreciation on the assets sold separately because of the marking scheme in the exam. So we have recorded the depreciation for the year 30,825 on asset number 1 and 3 that remain unsold, and we carry forward the balance 1,60,950.